continue your trip to Florida, so if I spend 2 days on my personal reasons, and then spend 3 days looking at rental property, no, looking at houses potentially to buy, I end up not buying.
All right, so 5 days in Florida, 3 days looking at houses. Now, what we have to divine again is, was she looking at houses or was she looking at houses? Right, there's a difference.
So if I really look at houses, as a result, I decided I'm not going to buy in Florida. Can I write off that trip too?
Yeah. Yeah, you should be able to write off that trip. Now, if you actually buy, the cost of the trip gets added to the cost of the house. So actually, instead of a deduction, it's added to the cost of the house and depreciated over time. So you're actually punished for buying, but you have to periodically buy to be credible.
So if I didn't buy, I can write it off at once, right?
I'm sorry?
If I didn't buy.
Yeah, if you didn't buy, again, it's a reasonableness thing. You didn't buy, but let's say you can show me actual offers and you can say, no, I actually spent this much time with this realtor, call her up and ask her. And sometimes they will. So again, did you look at houses or did you look at houses? Wait for the mic, please.
Saying that periodically, so what is that, like every month or every 6 months?
What do you mean? Periodically for what? You got to remind me.
For buying properties, like you said, you have to make offers.
There's no, you guys want to, are you an engineer? You guys want a number. There isn't a number.
No, it's all relative.
It's facts and circumstances. It's gray. I think you have the idea that if you do buy periodically, if one of your trips actually results in a buy, and it's credible, you have the evidence, you actually do it, you guys have a sense of what is and what isn't. It's just like they asked the Supreme Court justice, how do you distinguish between art and porn? And he's like, you kind of know when you see it. Now that would be a fun one to watch old Bill Clinton get on the Supreme Court and do that one. Hey, I'd like to have all the pornography cases. Could you send those my way? Thank you. Other questions? Now, we got to make fun of the Republicans. I guess Quayle wouldn't know what you meant by that. And Trump would say, if you showed him the porn versus art cases, yeah, I slept with her.
So we do video and a lot of photos with the realtor that we go actually.
You do video and photos with the realtor? Oh, that's cool. That's great substantiation.
And then
Of the house, right?
Correct.
Okay. Well, no, because I didn't know which topic it was.
We cut out everything else.
Well, but you know what? If it is the other kind of video and you're making money on it, it is business.
So did I hear you correctly? The basis is bumped up by the cost of that trip?
Right. So if you go on the trip, you show all the time you spent looking for the house, the meals, the time with the realtor, the gas, the rental car, the plane ticket, and you buy the house, you just add it to the basis of the house. It's just like you paid extra for the house. Yep. Beware the gingers.
I guess I will ask my question. Is this on?
Yeah, it's on.
So on the aggregation election, all my properties, they don't have any loss, even with depreciation. They're all positive. Is there any reason?
Great. So your properties, even after depreciation, still show a gain.
That's right.
Wonderful.
Yeah, so it's good.
Now we're going to talk about actually this screen here in a minute. We're going to talk about how, let's see if you're doing your depreciation the best way you could.
That's why I'm really interested in this one.
Okay.
That's why I was going to hold the question. But is there a reason to do an aggregation election in that case?
Is there a reason to do an aggregation election in that case? Only if you're paying the net investment income tax. In other words, real estate professional allows you to take rental losses against other income. The only time you would aggregate and be a real estate professional if it's showing income is if you're paying the net investment income tax and you want to not pay it, and you don't intend to sell, let's say you don't have any losses on them. I don't see a downside unless you change your plan down the road and start incurring losses. Because remember what we talked about, that each rental is considered an activity. So if you dispose of one rental, aka one activity, losses on it free up. You don't have any losses to free up, and as long as you think you're not going to create any, it's okay. So you see how involved this can get? We have a lot of subjective questions that we have to know, not just about what you're doing now, but what are your future plans? And so that's where we get into, by the way, if your bookkeeping, for example, is lousy, you're going to have a hard time answering some of these questions. It makes tax planning a lot harder. I can't emphasize enough clean books, income statement, balance sheet, buy property.
Can that election be made year by year?
Can the election be made year by year? The problem is you can't undo the aggregation. So once I make the election once, the properties I aggregated, they stay aggregated even if you become not a real estate professional down the road, except on Thursdays. Quick question. Viv, I'm going to put you in charge of something here. You seem to, I think you'll do well with this. Let me know what time it is, because I want to make sure I don't get so carried away in questions. I want to hit these other slides. What time? What time? 11:10. What time's lunch? Noon? Let me know at 11:30. I got to cover slides. It's your job. You got an accent. You're female. You got to boss me around. Oh wait, that's so sexist. Have you met my wife? It's not sexist. It's Pavlovian. I am trained. Who has the mic?
Wait, so back on the trip, you do your trip and you don't buy anything, but then a month or two down the road you end up buying something, same area. Do you still have to put that on the basis of?
Good question. I like it. Good question. So you take the trip, you don't buy anything, and then a few months down the road you buy. Should you add the trip to the property? I would say if it's before tax filing time, yes. Once the tax deadline goes by, I would not go back and amend. It's probably not worth it. Good question. You're really thinking. I like that. And by the way, that's what I usually like about Bay Area audiences. Usually thoughtful questions. Others, it's $3.50 an hour. This is your chance off the clock. I'm just saying. Okay, we got one there, and then we got one here up front. So our next one will be right up front.
Quick question. Could we write off when we take a look at syndicated properties?
When you take a look at syndicated properties, could you write it off? Yes and no. That's an investment, first of all. In tax parlance, there's a difference between a trade or business, which requires more activity and more of it be hands-on. When it's syndicated, it's an investment. And what's the problem? Investment gets written off on Schedule A, and for most of you, that's a problem, because miscellaneous itemized deductions on Schedule A only apply to the extent they exceed 2% of adjusted gross income. Wow, what does that mean? If you have $300,000 adjusted gross income, 2% of that $6,000, you can only take deductions on investments after they exceed $6,000. So if you have $7,000 investment expense, you get to take $1,000 of it. Schedule A is a lousy place for deductions. Unfortunately, you may be trapped into it because sometimes time doesn't allow you to have a trade or business on the side. I have that issue. My practice keeps me so busy, and I'm such a horrible property manager, I don't manage my properties. My activity on my rentals cannot rise to the level of a trade or business. It's an investment activity. The deduction framework for that is different. And by the way, what do a lot of people try to do in that circumstance? Add it to the basis. That's way better. In that case, you could take a deduction on Schedule A that you're probably not going to get. You could fill it out, but it still comes out zero. Or you add it to the basis of the property. Okay, at least you get more depreciation, and when you sell, less gain. So there's some gamesmanship where something that's normally bad, not being able to deduct it is normally considered bad. You take the alternate and you capitalize it, add it to the property. Given your probable tax circumstance, that's probably a better answer. So now what does that lead us to? I would be thinking of other expenses related to your investing that we could add to the basis of the property instead of deducting it. That's the larger lesson from your question. So good question. No pressure. 3 in a row? No, you guys all had good questions so far, but those are some really thoughtful questions. We have one right here, and then we'll come back over here.
Okay, going back to the question and the
Get right in
answer
there.
about bumping up the basis on the gentleman's question over here, or the gal that had the research question. Can you do that though when you're doing a 1031 exchange? You can't bump up, or is
Yeah, you
that
can.
for later?
Yeah, okay, so it depends what you mean by doing a 1031 exchange, right? But bottom line is this, the costs of investigating the property, anything that would normally be a capitalizable expense is still capitalizable in the context of a 1031. Right? When you do a 1031, you're still buying a property. You're just using money from another property, plus potentially some outside money, extra cash, extra expenses to research, extra debt. All that counts. So you want to track, and I have to emphasize, you want to track all of that. Why do I say that? Entrepreneur bookkeeping is almost a contradiction in terms. I think we have one over here.
All right.
And we got one, the next one in the back in blue. Put your hand up, please. There it is, so she knows to come after.
So I'm hearing you emphasize trade or business. Can you define those two?
I like you guys. What's a trade or business? Totally, there's a ton of case law. There are hundreds of cases, and it's going to be, remember this, because it's going to be real relevant in the context of your IRA and 401k. You see, outside of the IRA or 401k, normally because the deductions are better, we want a trade or business. But inside the IRA and 401k, because of something called UBIT, which we'll explain what that is, you don't want a trade or business. So just like the IRS, we're going to talk out of both sides of our mouth. We're just going to flip-flop when we do it. What's a trade or business? Depends on the level of involvement and the level of activity, right? It's the contrast between an investment that's totally passive and a business that you totally are into and running every day, lots of work and time. And of course, we get into these gray areas right in the middle where is it a trade or business or is it an investment? But it has to do with the level of activity. How much time do you spend? How much activity? How much of it is managed for you? And there are some patterns. For example, interest and rents on residential properties are usually presumed to be investment, not a trade or business. If you are buying and selling something a lot, or you are providing a service, that's usually presumed to be a trade or business, as long as there's enough activity to get you there. But what's enough? Utterly, utterly gray. What happens when the law is gray? We play. Most of the time, the tax system rewards you, and I'm going to give you some exceptions later. Most of the time, the tax system rewards you that if the law is gray, you take the position that favors you, because the penalties for doing so, if you get caught, are typically anywhere from non-existent to not enough to discourage you from doing it, as long as you have a good batting average. So for example, outside of the IRA, I have an activity that's not, it may be a trade or business, maybe it's not. I'm going to argue it is, because the mathematics favor me greatly in that respect.
So you can be both.
Can you be both an investor and a trade or business? Not typically with regard to the same activity, but if there are separate activities, yeah, sure.
IRA is separate activity.
And it can even be, because separate activity, well, IRA is definitely a separate activity from everything else you do. Plus, I could have a set of rentals here that I directly manage, and I can have stuff in Florida I don't manage. One's an investment, the other one's sort of a trade or business. Rentals are special in terms of defining them as a trade or business. That's something I don't know that I want to get into right now.
Back to this gentleman's question about the syndication. If you bought that, you said he could write it off in his Schedule A. Now, if you buy that in your business, wouldn't you be able to write that off in your Schedule C as a business expense?
Not necessarily. The question is, if you bought the syndication in your business, could it be written off as trade or business? Not necessarily, because a business can buy an investment. And then we have bifurcated treatment. Part of what comes out on Schedule C is business, and part of the other will be forced to Schedule A because it was not business. Even though it was in a business, that doesn't necessarily make it business, except on Thursdays. What time do we got, Viv?
11:17.
Okay, we got 13 minutes Q&A, or I'll just move into the depreciation slide.